Hello and welcome to Money, Me and COVID-19, where we meet with the leaders from the worlds of business and finance and investing to really try and understand the full impacts of COVID-19 and how we might need to change our behaviour to respond to it. My guest today has managed to combine being Scotland's largest residential landlord with also building a very large company in the rather fragmented world of business services and facilities management. Now, you might recall in one of my recent interviews with the mergers and acquisitions expert, Jonathan Jay, he said that COVID-19 will present us with an unprecedented opportunity to acquire businesses. Well, my guest today is living proof of that. He's just managed to complete a significant acquisition right in the middle of lockdown. His name is Graeme Carling. Graeme, welcome back to Money and Me.
Thank you, Graeme. Delighted to be back.
Now, usually I start these interviews by people telling me, how terrible things are for them in the current circumstances. But, unless I'm very much mistaken, you seem to be having rather a good crisis.
Well, we're having a busy crisis. It's been busy, I can assure you of that. Actually, since lockdown, and actually since the start of this year, but in particular since lockdown, we've really been busier than ever. And here we are almost at the end of the strict lockdown period, and it's flown in because we've just been that busy.
So you just managed to acquire a national heating and electrical company with over 300 staff. How on earth did you get that deal completely put to bed in the middle of all these restrictions?
Well, the story behind this is we were working on that deal for 10 months. And the deal was due to conclude earlier, certainly at the end of the first quarter of 2020. And it as these things do, there was delays and some issues, during the completion of it, and it dragged into the middle of March. I was actually away to the Himalayas when the whole COVID lockdown struck. And we didn't manage to get the deal done by the end of February, first week in March. I was away, still trying to get the deal concluded. Then I had to evacuate, if you like, 2 helicopters, 3 flights back to the UK, and we continued to work on the deal. Now, clearly, the dynamics and the whole outlook had changed because every business had been affected by the lockdown. Every business's value, where that was going to, how it was going to look going forward. So there was renegotiations, if you like, in terms of how we structured the deal, because we just had to do that because no one knows for sure, certainly when lockdown was going to be over and when things would get back to normal. So we were almost there at the end of February, and we finally got it done just middle of May.
So have you got staff on furlough in this company? Have you had to kind of take over in the middle of someone else's strategy for dealing with the pandemic?
We did because of course immediately before the deal concluded, the sellers still need to run the business just in case anything can happen. Until it's done, it's never done. So. The sellers, very prudent people, they run a great business, slick operation, and they done what they were supposed to do, or what you should do in order to protect the business. So they immediately furloughed, not all the staff, they provide essential services, and so certainly 2/3 of the staff were on immediate furlough. Then there's been a gradual, some have gone off and some have came back on again, but yeah, I mean, everyone was affected by it, so it was an interesting one. Yeah.
One of my friends runs a large electrical contracting business, and he's working on things like the Crossrail project. And he said one of the challenges he's faced is that he's had a lot of restrictions put on how his guys can work on site with social distancing and so on. But the overall contractor has not changed things like the penalty clauses in the contract. So he's still on the hook for late delivery, even though he's now working with one hand tied behind his back. Have you had any of those kind of contractual challenges in your work?
Absolutely. I mean, not necessarily with this recent acquisition, but our acquisitions at the end of last year and the middle of last year that we made, they're more they've been more susceptible to exactly what you said there. The latest acquisition, fortunately, has a lot of government, local authority, housing association type contracts. So it's not private contracts where it's an easier conversation because they're aware of the situation, and it's been an easier. They've worked with us and as we have with them in order to we've been available as we've been needed, but they haven't kept us. Look, you must stay here until this time, and particularly in Scotland, there was mixed messages. The construction side has, to all intent and purposes, kind of continued down south. The businesses that we've been looking at down south, they've been able to operate on a scaled down version, social distancing. That hasn't been allowed up here in Scotland. It was a straight, you're off site and that's it. So, so we've been pretty fortunate in that, where across the group, we have a pretty low exposure to private contracts, like what you're saying there.
Okay. So what was it? I think your plan is to build a £300 million business here. What was it that attracted you to the world of building services and facilities management as the target for what you wanted to build this large company out of?
Well, what you have is it's a very fragmented market. It really is. There are some real cracking regional businesses right throughout the UK. And what they do is they seem to get to a certain level. Then once they get to a certain point, they either from when they go from operating independently to try and be a larger scale, that's the real danger zone for them. They have to commit heavily to overhead, commit heavily to resource prior to basically obtaining any revenue. So what we've seen is where we can go and acquire good, well-run businesses and consolidate them, let them do what they're good at, and we can support them from a business function, share overhead, resource when it comes to HR, all business functions, accountancy, back office functions. So it allows these companies to grow without the risk of the overhead. Because when you look at the number of failures over the last few years in particular, it seems to have been the smaller guys that have got ambition, and so they should, but they get stuck in this danger zone. And we feel that there's an opportunity there to consolidate this. And there are some really good, well-run businesses around about the 20 to 30 million mark that kind of get stuck there, but work well, managed well, make a profit. As soon as they go above that, 40, 50, 60 million, they're in the danger zone. And it's almost in every business that we've looked at in the sector, they're almost identical. Their profits go down, it gets mismanaged more. So we just see a huge opportunity in that market where there is value in it, and we believe, the sum is greater than individual parts.
Well, it's interesting because Daniel Priestley has a sort of diagram that describes this really well, and it's jumping across what he calls the desert to get from that sort of 10, 20 million business up to 100 million business. And that is, as you rightly say, the danger zone. So do you think that coming out the other end of COVID-19, there's going to be rich pickings for a company like yours that's looking to acquire business? Are you going to be able to pick up some bargains of companies that have really struggled coming out the other side of this?
Yes, absolutely. And I think we are well positioned. That was, we were doing this pre-COVID anyway. Like I say, the business that we purchased just recently was 10 months because there was a delay, because the whole dynamics of and structure of the deal had to change because of COVID. But there is no doubt about it. 25% of the businesses that were there pre-COVID won't be there in a year's time. It's as simple as that. So the world is changing before our eyes. We need to manage our businesses well, first and foremost. But there is no doubt, as far as I'm concerned, there is the opportunity for acquisitions to acquire value, good, well-run businesses that have just been hit by this. And I think it makes sense for those businesses as well, because it gives them the strength of being part of a larger group. And we think, we're well positioned for that. So, yeah.
Okay, well, I mean, the other side of your own empire, and that's the one we focused on in our initial discussion, was very much your property business. And at the time we spoke, it was all about the impact of George Osborne's changes and how your profit per unit had been coming down. I can't imagine that's got any better during COVID-19.
It certainly hasn't, no. And the rules up here in Scotland are different, and to a certain effect, worse on certain aspects of the whole rental market. The tenant is very much protected, and there's additional measures in place up here compared to down south. So, no, but, the one fundamental that hasn't changed is there is still a national housing shortage. That hasn't gone away anywhere. And the market that we're in, which is mid-market, it's always been a relatively safe market. We are still seeing pretty high occupancy levels across our portfolio. But the ones that are getting are getting, I suppose, hammered the most are at the higher value end, whether it's higher value sales, higher value rentals. And if you look back traditionally, whether it was in the UK or in the US, traditionally when there's a recession or a depression, the higher end multi-family or P&S schemes are normally the first. They get hit the hardest. And they get hit the hardest because people, they have to adjust, they have to cut their cloth accordingly, and they will tend to move into areas that they wouldn't have chosen when things were great. And actually, they need to move. So we've always been never in the too fancy end, really in the affordable end, not low end, but mid-market. And it served us well during the last sort of recession, and we hope it does the same now.
Well, I mean, on a national basis, I'm reading that residential rents are only about 50% are being paid on time at the moment. What's been your experience in Scotland?
We haven't had that, fortunately, and I'm touching wood here. There's been a greater number of tenants asking for holidays or can I have a couple of months off. But what we've seen is, and you need to take this back to what's actually been happening. The government, at the moment, we are going through what appears to be the greatest economic experiment ever that I've ever known anywhere, I've ever read about, ever in the history of the world. And it's an experiment. So what's happening is the government, they're effectively, it's helicopter money. They're giving, furloughing people. They are, all these bounce back loans and self-certified loans. At this moment in time, actually, there is money in the system, and that seems to still find its way for people paying their rent. Not everyone, but a lot of people are continuing to pay their rent because they're getting universal credit, or they've been furloughed. So will that continue going forward? I don't know. I don't think so. I think we're saving this up for probably the later part of this year, early part of next year. But right at this moment in time, we haven't been as hammered as we thought we could have been. So that's what's been happening here. But there's no doubt about it. Sorry, there's no doubt about it that certain people will either take advantage of this situation or simply can't afford to pay their rent for a period of time. So.
Yeah, I guess the question really coming out of all this is, on top of all the other things that have changed in the last 5 years, Section 24, all the stamp duty hikes, capital gains, etc., plus the uncertainty from COVID-19, as we come out the other end of this, are you going to be looking to buy more investment property, or do you think you might be looking to divest some of the portfolio?
Well, I think we're always divesting and always buying. We're property people. So I think there will be a mixture of what you say there. We will be looking to divest some of our stock. We are at the moment, but there will be other stuff that we're always continuing looking to buy where it makes sense to do so. And we've been doing this a long time now, so I'm saying we're a bit more cautious now than we probably were at the beginning, and I think rightly so in this current market, because as I say, this is an experiment. No one and like an experiment, no one knows the real answer until it happens. So, you know, we'll continue to move forward, and we'll just, as long as we stay vigilant and stay focused on what we do, we'll just need to make the call as and when these opportunities come up.
So a lot of residential buy-to-let landlords will be watching us. What kind of advice could you offer to them on how they should be thinking about formulating their own post-COVID-19 strategy?
Well, you know, like everything else, and I'll say it again, there is still a shortage of housing. That hasn't gone away. Don't kid yourself on the numbers. You know, I see it now. I'm seeing it time and time again where people are so bullish on pricing. They are not understanding the real costs. That you really need to get, you really need to understand your numbers on doing it, because there are still bargains there. There are still great investments to be done. But are you a good investor? How good are you? And that for me is key. It doesn't matter, up market, down market, there are always good investments in property, always. But you can get caught out, and you know, it's not all plain sailing like a lot of gurus will have you believe.
Well, let's stay with property, but move beyond the residential area into commercial. Now, you know, retail issues were already well known before COVID. Yeah. One of the things that's really seeming to happen now is that people are reassessing whether they want to go into a city centre, to a big office to work, and the companies that employ them are thinking, do we need the overhead of this big commercial building? How do you see all of this playing out in the commercial property sector?
Well, I'd be concerned in the commercial property sector. You know, I can't see anything else other than that. I think it is a worry, and I don't know how it's going to pan out. But certainly at the moment, you know, it's big commercial landlords. And I just had a meeting about this on Monday. These guys have to be seriously worried at this moment in time. And a lot of the, you know, even a lot of the government schemes, you know, certainly up here in Scotland, similar, where they're giving you some money for grants are available if you're a certain size and you're in a certain sector. A number of these big commercial office buildings and stuff, there's nothing for these guys. So there's been very little by way of support. So it's almost they're sitting in a no man's land area and really taking a hammering. So I don't have the answer for it, I'm afraid, but I do have my concerns for that part of the sector at the moment.
Yeah, and I think what a lot of people don't realise is a lot of these big commercial buildings are actually owned by pension funds that want them for their annuity rental income to pay their pensions. So the upshot of that down the line might be that there's less money around to pay people's pensions. So it's a biggie.
Yeah, absolutely. Yeah.
Now, on a totally different subject, I'm the odd one out on this call because both you and my producer, who's behind the scenes, Michael Hammond, recently went across to America to visit Robert Kiyosaki in his home. Now, tell me, what sort of part has Robert's advice and coaching played in your success?
Well, I mean, a huge part. We, my wife and I, have been going across to Robert and Kim's seminars since 2008. I think it was 2008, and we've been going back. We're going back 2, 3, 4 times a year. So we became close and friendly with them over a number of years, and even to this day, you know, the Rich Dad Poor Dad message is still relevant to it's still relevant today as it was when I read the book in 2002. So, and I think it was written, you know, many years before that. So, a great guy. They're still working, hardworking, mission driven. You know, the huge difference we always got was they weren't trying to sell us anything. You know, we didn't get, you know, as Scottish people, we're a bit, you know, resistant of folk. You know, we're very wary and, you know, we'll always take a back seat. And I never got, you know, so we're always looking at what their angle is. Across there, I never got that. I genuinely believe, and still believe to this day after all these years, they are completely mission driven, and what the message that they're getting out there is still every bit as relevant today, as I say, as it was all those years ago.
Okay, well, I mean, one of the things Robert's being very vocal on at the moment, in some ways it kind of is a prediction he's been making for some years, is the kind of demise of the US dollar. And he's basically shouting from the rooftops, we should all be buying gold, silver, and Bitcoin.
Yeah.
Is that advice that you're taking on board?
No, I don't do that. We have other investments. I agree with the demise of the dilution of the currencies throughout the world. You know, you look at what's happening here. I mean, where did we get that bazooka within a couple of weeks? We've pulled out, the bazooka has been in the drawer, and within a couple of weeks of COVID, bang, we've got 7 million people on furlough. You know, where did that come from? That was quick. You know, we're writing off NHS debt that's been there forever. And, you know, all these things are coming out the bottom drawer, it appears. Then, again, it's an experiment, but what is absolutely fundamental in it is, as far as I see it, is the dilution of the currency. So my chosen asset class is property and business. That's what I concentrate on. And I'm, you know, kind of diversified, but I'm really all in as well because I understand it as what we do. We don't park. I don't have anything in gold and silver, and we've never dabbled in Bitcoin. Thankfully, actually, because I probably would have got it right at the top.
Okay, but it's interesting in a way that, I mean, you talk a lot about this experiment. One of the things that I think investors generally are trying to get their heads around is, where is this going to lead us in terms of either, you know, deflation, which obviously shutting the economy down is very deflationary, or inflation from pouring all of this money in. You know, where do you see us ending up over the rest of this decade on that kind of deflation versus inflation spectrum?
Well, I think, you know, it depends who you speak to. If I go back to 2008, I remember sitting in my bank office when they cut interest rates down to below 1%. And they said to me, take a fixed rate mortgages now, because I can, the interest rates will be shooting up to 5% within, we reckon, 9 to 12 months, because they've been at a conference. I'm saying, well, hold on. Can you guarantee that? Why is this going to happen? And of course, here we are at point one, you know, here we are, 13 years later, and we've been nowhere near that level. No one really knows, I think. I think what we're seeing is that, you know, the fighting going on with oil and gas and all that stuff, what effect is that going to have on it? Logic would say to you, you're printing all this money, there's got to be inflation or even hyperinflation. Right? That you're printing so much money right across the globe. All major economies in the world are doing that at this moment in time. So that would suggest there would have to be hyperinflation or inflation. But really, that was, you know, there was quantitative easing and low interest rates 13 years ago. Where's the inflation been? So I don't know is the honest answer, but we need to be vigilant to see what this actually does. You know, the conversations I'm having at the moment, again, logic will tell you that taxes must go up because we've got to pay off the debt. Well, personally, I don't think there's ever any intention of paying the debt off. I don't think, personally, that the US or the UK can ever pay the debt off. They can, but that's not to say we won't be taxed. I think we'll be taxed, but but will it all go to paying the debt off? No. You know, maybe some of it or a small amount of it. But I think that taxes at some point will go up. But I think they've had this in the bottom drawer, this bazooka, for circumstances like this for a while, because it happened all so quickly, and, you know, without any real debate at all. All the major parties, political parties, were in agreement, and bang, the bazooka comes out. Then, you know, the fighting's starting now, but at that time, you know, everybody was pretty much in agreement.
Okay, and the other sort of item that has been pushed right off the agenda now, but we shouldn't really lose sight of it, is we're only about 6 or 7 months away from when the whole Brexit is supposed to happen.
Yeah.
Now, you know, hopefully the decisions taken by the Chancellor in the coming months will not just be to respond to COVID-19, but to prepare ourselves for the kind of Brexit Britain that we want. And, you know, what would your message to Rishi Sunak be about the kind of things you'd like to see him doing to make for you as a businessman and a property investor to make Brexit Britain as successful as it could be?
Well, I think we need to get the timing right. You know, I think everybody's just, you know, we've accepted that it's going to be. I think we just need to make sure we get the timing right for this now. And whatever the plans were pre this, and you know where the benefit, economic benefit to the country, but you know for business and commerce, we don't lose that because we're in a rush now to get the deal done by the end of the year. You know, if there has to be a delay of 3 months because there was a 3-month lockdown, I think we need to, you know, whatever it was before, let's not rush into it just for the sake of the deadline, which is the end of the year. So other than that, you know, again, we need to see what's going to happen with the whole commerce side situation. And I'm a glass half full guy. So I believe that, you know, we'll be able to adjust. Commerce will adjust. Entrepreneurs adjust to things, and we'll, you know, if there's issues, we'll just need to go through them. And so I don't get too deep into it, but I genuinely think a lot of this now is not so much the specifics, because the specifics really don't mean a lot if we don't get the timing right.
Okay, and just on a more colloquial point, you know, you mentioned that the rules around building sites were different in Scotland, and now, of course, Scotland's gone a slightly different direction regarding, you know, how to free up lockdown. What would your message to Nicola Sturgeon be on what you'd really like to see the government doing in Scotland to help the economy get back on its feet?
Well, I don't think we should have the differences there are to the rest of the UK or in particular England. I don't think I personally don't think it's necessary. I think it would, the construction sites under safe working environments, there was no real reason through this period. You know, I get it, you know, it's a serious situation we're in, but, you know, we take our business seriously. We, you know, and if we're under a directive that we have to socially distance and manage sites, as we will do when we get the end of lockdown, I don't think that we need to be that different. Just, it appears, just for the sake of being different.
Indeed, okay, but I think the main lesson to take from your example is that entrepreneurs will always find a way, and that even in the middle of all this once in 100-year kind of phenomenon, you know, you've managed to do something constructive to grow your business. So what would be your kind of final parting message to the business owners watching us that can perhaps inspire them through these most challenging of times?
You need to keep moving. You know, you need to keep moving. I'm not the type of person, and entrepreneurs don't go and curl up in a corner and feel sorry for ourselves and hide away. You know, we've been busier than ever since lockdown. We haven't, you know, been watching Netflix or you know whatever it is we've been doing. We've wasted no time. We've really taken advantage of the situation. In actual fact, because everyone has been at home, it's been a lot easier to get hold of people. Everyone's available, so we've been able to work harder, longer, and achieve more. So as an entrepreneur, you just keep moving forward. And by the way, we're going through the same unknowns as everyone else, but we don't let that stop us. And that is, in my view, why, you know, the people that normally thrive in these situations, we just keep moving. And we don't always get it right, by the way, you know, we don't, but we just lick our wounds and readjust, learn the lesson, and move forward.
Fantastic. Okay, well, you know, all power to your elbows. You go on growing your business and your property empire. Graeme Carling, thank you very much for joining us.
Thank you, Graeme.